What's up everybody, Nate here. Great news! We actually just got the most recent unemployment data, and unemployment actually dropped by 0.2% in the month of September. That means it went from 3.7% down to 3.5%. In addition, the United States also added around 266,000 jobs during that time. That is just lower than what the Dow was estimating, but it is a really good sign for the jobs market in general.
Awesome! Awesome!
However, the bad news is that we've seen this before, and when this usually happens, bad things tend to come.
Historically, not awesome.
Looking at the jobs data from the last 50 or 60 years, I noticed a trend just the other day. Every single time jobs numbers hit a record low, they typically spike really high after that. Now, when you actually compare that to what the Federal Reserve is doing and has done in the past, and not only that, with inflation and our record of recessions in the United States, you can actually kind of pinpoint what is going to happen next with the United States jobs market, and that is exactly what I want to talk about today. All right, so let's jump into things. So I actually noticed a trend in jobs data and the United States Federal Reserve federal funds rate policies. So the federal funds rate is essentially the rate that they give to banks and other financial institutions when those banks and institutions borrow money. Just like you go to the bank and get an interest rate to borrow money from the bank gets an interest rate to borrow money from the United States government. Well, when the Federal Reserve raises its interest rates, well, that means that it makes it a whole lot harder for the bank to get its money, and when it lowers them, that means it makes it easier. So that is pretty flexible from the bank's perspective. They can then raise their interest rates to make it harder for you to get things like a mortgage or an auto loan, or they can make it easier. It really just depends on what the United States government is doing. Now, a huge comparison can be made to what the Federal Reserve is doing right now to what it has done in the past. So what exactly is the Fed doing right now? Well, the Fed in 2022 has been aggressively and quickly raising its benchmark interest rates. This is, of course, to make the dollar stronger, not only in the US, but across the world, and they want to reduce inflation. We had a lot of spending and a lot of money printing and a lot of low interest rates over the last couple of years. So now the Federal Reserve is turning around and making it a lot harder for money to circulate throughout our economy. When they raise their interest rates, that means that it's harder for everybody to get money. It's harder for people to get a mortgage. It's harder for investors to invest in businesses. So everything starts to shrink, and when everything shrinks, that means prices come back down because there is no demand. If you simply can't get a mortgage because the interest rate is too high, then you're not going to get one, meaning demand comes back down. And with investors putting less money into businesses and the Federal Reserve pulling billions of dollars every single month from their quantitative easing program, now called quantitative tightening, that means that there's less liquidity on Wall Street. So that means all of these businesses don't have as much money to spend and grow, and they're going to try to cut costs as much as they can. Usually that means firing people. So what the heck does that actually have to do with the jobs numbers? Well, you can pretty much see a complete comparison of what the Federal Reserve is doing with its interest rates and the jobless claims over the last 40 and 50 years. When the Federal Reserve lowers its interest rates, that means there's a lot more investment. That means there's a lot more spending, and it also means that inflation does go up. As the Federal Reserve lowers its interest rates more and more, you're going to see more and more people employed because businesses have all of this money. Think about what happened in 2021. Because the Federal Reserve had its interest rates at nearly 0%, everything exploded. The stock market hit new record highs. Businesses were hiring people probably more than they even needed to, and they were paying them basically whatever they wanted because they had the money to do so. There was just so much money everywhere, and that also meant that our entire economy exploded. It grew by a significant amount in 2021. There were so many US dollars, but with all of that spending, inflation also started to become a problem. By about the summer of 2021, all of that money printing and low interest rates really caught up to the Federal Reserve and the United States economy, and now in 2022, inflation sits at an over 40-year high of around 8.3%. it. Now, we have been in this situation before in the United States. The Federal Reserve has a duty to the United States government and the United States economy to kind of keep an eye on the monetary supply and inflation. They have two basic responsibilities. They can grow the economy and boom the economy by lowering their interest rates, or they can control inflation, which means that the monetary supply of a country is going up. They have complete control over inflation and our economy in these ways, and they do that with their monetary tool of interest rates. They can raise them or they can lower them. Every single time in American history when inflation becomes a problem, the Federal Reserve raises its interest rates because they know that this is going to mean a lot less spending, a lot less business growth in the US, and unemployment is going to go up. And the Federal Reserve counts on this because the fact of the matter is when people don't have jobs, they don't have an income. And if they don't have an income, they have no money to go out and buy things. That means prices for everything in your economy suddenly start to go down. The Federal Reserve has to control this though, because like I said before, as they raise their interest rates throughout history, when we've seen them do this very quickly, like raising their interest rates by 4 or 5% in the span of a year or two, that has pretty much always meant a recession has followed. And when the United States is in a recession, they typically go back and lower their interest rates. That means that businesses can once again start to grow and unemployment goes back down. However, from what we've seen in the past, if the Federal Reserve actually raises its interest rates very slowly, like say 5 or 6% over the span of 5, 6, and 7 years, then that could give businesses enough time to actually calibrate to what is going on. The problem though is in 2022, the Federal Reserve doesn't really have a choice but to raise its interest rates because inflation is so out of control. What's really interesting though is, like I pointed out before, every single time the Federal Reserve raises interest rates, unemployment suddenly spikes. And then once we have really bad unemployment in our economy, we typically go into a downturn or a recession, and then they lower interest rates. But in 2022 and in 2023, the Federal Reserve actually might continue to raise interest rates even though we are in a technical recession right now. What I'm saying is the Federal Reserve might continue to raise interest rates even though the United States economy is in a recession.
I'm sorry, what?
That has a ton of negative effects because now we have a situation where people are losing their jobs left and right, businesses are shrinking, and the Federal Reserve is making it even harder for people to spend money. And the fact of the matter is the Federal Reserve can't really do anything else. If they were to lower their interest rates, well, that would mean that people start spending again. The problem is that's just going to make inflation go way back up, right? Because now people are spending money like they did back in 2021. So that is not really going to fix the problem. And this issue that the Federal Reserve is facing right now is an issue that it's been facing for probably the last 10 or 15 years. If you look at the numbers back when the 2008 Great Recession really started, well, the Federal Reserve started to lower its benchmark interest rates. We had really bad unemployment and we actually had deflation in our economy. And that's because that problem wasn't caused by inflation. It wasn't caused by a whole lot of money printing. It was actually caused by a whole slew of other things, particularly stock market greed with the housing market collapse. But still, the Federal Reserve lowered its interest rates and they pretty much kept them at around 0% for almost 5, 6, and 7 years. They didn't really start raising their interest rates again after the Great Recession of 2008 till almost 2019, and they started raising them pretty aggressively and pretty quickly. They got up to around maybe 2.5%, but then we had the problems of 2020 with the pandemic and interest rates went right back down to 0%. So what I'm kind of getting at here in explaining all of this is that the Federal Reserve has had a massive impact on our jobs market for the past 10 or 15 years, and there has been a lot of money printed and a lot of markets and businesses expanding over the last 10 or 15 years. They've been building brand new positions and people and hiring all of these new positions for pretty much an entire generation because there was so much money that was readily available for such a long period of time. Now in 2022, they do not have a choice but to cut all of that. I've talked a lot about on this channel that businesses are starting to cut the extra people that they hired in 2021 because let's face it, they overhired and they overpaid people because they had to because of things like the Great Resignation. But what my fear is now is we're going to see additional firings and additional layoffs because of all of the other people that were hired during the last economic boom. The fact of the matter is our jobless numbers and unemployment numbers are really, really low. And in the Federal Reserve's eyes, that means there's way too many people that are spending money in our economy. So they have to drive up unemployment because that is the only tool that they have to battle inflation and to turn around our economy. We have already started to see job postings in the United States rapidly decrease on a month-over-month basis by around 1.1 million. And that means to the Federal Reserve, businesses are not looking for as many people to hire. So they're not quite at the phase where they're having mass layoffs or mass firings, but that is what's coming next. They start to look at their balance sheet and realize they can't afford any new people. And then they look at it again and realize they can't afford the people they have. At the end of the day, these businesses are still going to try to make a profit. They're still going to try to save their business and maintain their business in the short term. And that could mean firing people. Job numbers are still pretty solid in the United States right now, but that could change as the Federal Reserve quickly and aggressively raises its interest rates. Like I said, pretty much every single time they have done that, a recession has followed. That usually means that they lower their interest rates, but not this time. They have to fight inflation to bring it down to their target level of around 2 to 3%. And long story short, that means that the United States could end up losing millions of jobs over the next couple of months because these businesses have no money to pour back into their company. Now, obviously, this is not a guarantee. The Federal Reserve could see that the United States is in a recession and they might actually start lowering their interest rates again in 2023. That would mean everything booms, and it would mean that the US jobs market actually does start to improve if we do see unemployment go up. And that's something that the Federal Reserve is going to keep an eye on with their interest rate policies. But one thing is absolutely clear though. Unemployment data is at its lowest point in a very, very long time. And the Federal Reserve right now, with its fight against inflation, simply can't have that. Meaning as we see those rates go up, you most likely are going to see unemployment go up too. But now I want to hear from you on this issue. What do you think about the most recent jobs data? Do you think unemployment is set to go way up in 2022 or in 2023? Or do you think that unemployment is going to stay exactly the same as it is right now? Whatever your thoughts are, leave a comment below before you go. But that is it for today's business and financial news breakdown. Thank you so much for watching. If you want to stay up to date with all the top business and financial news from around the country, our team puts together a free daily newsletter, and you can subscribe to it by clicking the link in this corner right here. And if you want to stay up to date with me and everything else happening in the business and financial world, I'm putting out updates 7 days a week over here on this channel, and I've actually got another one ready for you right here, so be sure to check that out before you go. That is it from me, everybody. Be kind out there, and I'll see you all in the next one.